So, how big a threat is the Wall Street credit mess to the U.S. consumer? Joining us from our D.C. bureau, Bill Hempel, Chief Economist of the Credit Union National Association. Bill, it's great to have you back. And, you know, over the past several months, you've frequently talked about the headwinds facing the U.S. consumer. Falling home prices, job layoffs are rising, high energy prices. But now we've got this turmoil in the financial markets. What are you seeing? What are you hearing from your members? What are they hearing from their customers?
Right. Actually, I think the effects of the turmoil in the financial markets could be overstated on the consumer. It's certainly not good news. As you said, the consumer we're in the beginning of a consumer-led recession, and what's happening to the consumers is what's driving that, of course. But the Main Street effects of what's going on Wall Street might be somewhat overstated. The typical consumer probably didn't know until a couple of weeks ago what a Freddie Mac or a Fannie Mae or a Lehman were. Merrill Lynch a little different, so this is disconcerting, but they're much more influenced by things like the price of gasoline than by what's going on in Wall Street. I'm not saying that this is not going to hurt consumer confidence, consumer spending, but I don't think it's as big an effect on consumers as some of those other drivers that we were talking about before. So
let's talk about this big ocean that consumers swim in or float in. Maybe they don't always know because they're in this big boat, right? But one of our previous guests was talking about what's happening to bank lending and the contraction in commercial paper and how that funds big corporations. In terms of this broader sense of credit growth and credit availability, how will that affect the credit unions? Therefore, how will it affect availability of credit to the consumer?
Well, you know, most banks that didn't concentrate in subprime lending or things like that, and virtually all credit unions still have money to lend, and they're still making loans. So we're getting winners and losers among consumers now. If you're a consumer with a really good credit rating, you can get a loan still from a traditional lender, if that lender is funding the loan from its own deposits. If that lender requires access to the capital markets to fund the loan, forget it. But an awful lot of consumers are getting their loans from portfolio lenders. Particularly advantaged now are first-time home buyers with good credit with a little bit of down payment built up. The home prices have fallen substantially. They're much more affordable than they used to be. And also, mortgage rates are coming down for two reasons, because the government now is explicitly backing Freddie and Fannie, and because Treasury rates are falling. So I'm not saying that happy days are here again, but there are some positives building that weigh against some of the negatives coming out of Wall Street. You know,
Bill, a lot of people who don't invest a lot might still have some money in money market funds, and we're still seeing some pretty big ones breaking the buck, as they said. I believe Bank of New York Mellon, its institutional fund, was the latest one to do that. Is that a risk to consumers?
I think consumers will get overly concerned about that, and I think the biggest risk to consumers right now is that they do some stupid things precipitously because of their concern, you know, rushing out of certain investments just because things have fallen so much. You know, they'll end up selling low and then buying high later on. But if consumers are really concerned, they can, of course, go to federally insured deposits, which at credit unions, deposits are federally insured up to $100,000 account, just as they are in banks by the FDIC.
Do you expect the Fed to cut interest rates this year, Bill?
I was surprised that they didn't cut them a few days ago. As you may recall, a few months ago, I have said that I wouldn't be surprised that the next move would be down instead of up when a lot of people worry about inflation. So, yes, I think they will. And it could be before the next meeting, too.
Okay, Bill Hempel, we'll see how that goes. Thanks so much for joining us.